Hi, I'm Lindsay from KOSEC Kodari Securities, and today I'll be discussing debt to equity. It's one of the key fundamental metrics utilized by KOSEC as part of our evidence-based investment strategy, and it's crucial for assessing the financial health and risk of a business.
As always, all information given is general in nature and does not take into account your personal needs or objectives. For further information, visit our website www.kosec.com.au. So today, we'll provide an overview of this financial metric. We'll then explain how it's calculated, and finally discuss why it's important to equity investors and provide some practical examples from companies listed on the ASX. As mentioned, debt to equity is critical for assessing the financial health and risk of a business and is therefore a crucial consideration for equity investors. As the name suggests, it's a measure of how much debt a business has in relation to its equity. In that sense, it examines the relative composition of a company's capital or how aggressive a company has been in financing its growth with debt. So how do we calculate debt to equity? The debt to equity ratio is simply total liabilities divided by total shareholders' equity. This ratio is also commonly known as gearing. It's also worth noting that the numerator is often modified to consider only long-term liabilities, or those with a maturity of more than 1 year. So why is debt to equity important? Essentially, it provides an insight into the potential risks of investing in the company. A low debt to equity is generally more desirable as the interests of the business are better protected in the event of a business decline. A company with high debt to equity may be perceived by investors as being more risk-prone and thus a less desirable investment. However, it's important to note that this is only generally true. A higher debt to equity or gearing may not be detrimental in certain scenarios. While it's true that debt ranks ahead of equity in the unfortunate event a business goes into liquidation, creditors' claims are fixed while shareholders are entitled to the residual. This means that an efficient use of debt versus equity can boost shareholder returns. This reflects the concept of leverage, whereby debt funding is utilized to expand a company's asset base and generate returns on risk capital. Quite simply, if that leverage increases a company's earnings by a greater amount than the cost of that debt, in other words, interest expense, then shareholders will reap the benefits. With higher risk potentially comes higher reward. Now, it's important to keep in mind that what constitutes a normal or high or low debt to equity is very much dependent on the particular industry or sector that the company is in. For instance, companies in the energy and utilities sector are characterized by lower growth but more stable and predictable cash flows, and are therefore able to raise more debt at lower interest rates. For instance, in the 2019 financial year, Origin Energy had a net gearing of 46%, while Oil Search had a net gearing of 64.6%. In contrast, companies in the technology sector are characterized by higher growth but less predictable cash flows, and are therefore less likely to have a high debt to equity. In fact, their net gearing ratio may be negative, meaning that the company's cash exceeds its debt. For instance, in the 2019 financial year, Appen had a net gearing of negative 10.9% after having a net gearing of positive 11.7% in the 2018 financial year. EML Payments had a net gearing of negative 12.5%, while Kogan had a net gearing of negative 51.4%. So in summary, this means that a meaningful analysis of debt to equity should involve a comparison with the company's industry peers, analyze whether it's stable, trending up or trending down compared to the company's historical metrics, and also consider how that leverage is being utilized.
So in this video, we provided an overview of the financial metric debt to equity. We explained how it's calculated. We also discussed why it's important to equity investors and provided some practical examples from companies listed on the ASX. So I hope you found it helpful. This video is brought to you by KOSEC Kodari Securities.